Hi, this is Wilfred Ling. Do you know that investors who invest in index funds such as Vanguard funds underperform the fund itself significantly? If you want to hear more, do continue to listen to this video. Research has shown that many active managed funds underperform the index. Hence, the logical thing to do is to invest in funds that mirror after the index. Over the years, there have been significantly more and more funds that mirror after the index, such as exchange-traded funds. In fact, if you research the internet, you'll find countless articles, blogs, and forum pages advocating the use of index funds. However, if you were to track the record of these index funds, you get to see an interesting picture. Consider the Vanguard Global Equity Index. In the performance table, which I call Table 1, there is a field called Investor Return, which I highlighted in yellow. Investor Return captures how the average investor fared in a fund over a period of time, and it is calculated by Morningstar. On a midterm basis, say 5 years, the tax-adjusted returns of the fund and the investor return was almost on par. However, on a long-term basis, say 15 years, you will notice that the investor return underperforms the fund tax-adjusted return by a whopping 2.12% per annum, highlighted in red. Similar statistics show up for Vanguard Emerging Market stocks. In fact, for this emerging market fund, the average investors underperform the fund's return both on a short-term basis and a long-term basis. To be fair, this isn't just happening to index fund investors. The high-flying Fidelity Magellan Fund was managed by the legendary investor Peter Nietzsche from 1977 to 1990. Under his management, the fund averaged an annual return of whopping 29%. Yet, Fidelity reported that the average investor in this fund lost money during that time by making emotional decisions due to adding more after strong performance and selling during downturns. So, what can we learn from this observation? First, be careful of what you read on the internet. Internet gives you a lot of information. However, what's lagging is wisdom. When you hear of articles advocating for investment into a certain style or product, what you get is information, not wisdom. Wisdom comes from experience in helping large number of investors knowing what's work and what are the things that are unlikely to work. Second, do not focus on the trees but miss the forest. Many people focus on low cost fee but forget that the largest, most expensive fee to pay is not able to manage one's emotions, such as buying high and selling low. What is the point of saving on the fees when emotions are going to cost you heavy losses? Third, what you read on the internet are mostly written by writers rather than financial practitioners. Even if the writer has experience, it is usually based on their own experience, which may not be operate as everyone is unique. Finally, in Singapore, the government does not regulate articles written by non-financial practitioners. That means they can say anything they like without repercussions. If you want to know how you can benefit from my advice or wishes to sign up for my webinar, do click on the link below. See you.